Hi, today we're going to do a brief price earnings ratio video, and this is for use in your analysis project. And I don't want you spending a lot of time on doing stock analysis and valuation because that's really not the subject of an accounting class. It's really a subject of a finance class. But I wanted you to kind of get a glimpse of this so you can utilize it to form an opinion on whether to buy, sell, or hold your stock. So first, let's look at price earnings ratio, what it is and what it isn't. And we'll start with what do we know about it and what is market value in kind of a conceptual sense, and look at what could happen to a stock and how that might be reflected in the PE ratio. Secondly, we're going to show you how the PE ratio is calculated and how you can find information that might help you in your project. Next, we're going to then look at how can you apply what we just did and get a very quick measure of an estimated price earnings. And we're going to use an example company, Logitech. You may know them as a computer peripherals and accessory business that has been around for a long time, based here in Palo Alto. All right, PE ratio stands for price to earnings ratio, and what it is and what it isn't. First, what it is the market perception of the future growth rate for a company's stock. Very simply stated, if the company's stock value is expected to go very high in the future, it'll have a high PE. If it's low, mature company, it's going to be low. It doesn't mean it's a bad stock. It just means that the expected increase in the price is not that high. And then what it isn't, it's not magic. It's not a way to predict this price of the future stock. We're going to use it for that purpose today, just to get an indication of your sentiment toward a stock and how the market might share or not share your opinion. In case you're curious, this is how it's really done. The primary method used for valuation by stock analysts is the discounted cash flow method, using projections of free cash flows and the cost of capital based on the capital asset pricing model. And what you'll notice is we just covered quite a few buzzwords. For example, we use the term discounted cash flow and the term free cash flow and the term capital asset pricing model. These are three of the primary things you'll learn next mod in your managerial finance class. But we're gonna look at that later on. For now, we're gonna stick to the simple price earnings ratio. The formula, again, is very simple. You take the price per share for the stock divided by the earnings per share, and it reflects the future growth rate in stock. Let me just show you a picture of what that means. Let's say this is time, and this is dollars per share. The stock price could be right here, whatever that number may be today. And the future for the company might be kind of moderate, or it could be low or down, or it could be high, right? We don't know that. All we know is today's price as compared to its today's earnings per share gets you a PE ratio. So the way we interpret it is we have earnings per share. That's a known number. How do markets perceive the stock? That's seen in the stock price. When you divide price by earnings, it gives you an indicator of how bullish the stock market is about that company. High PEs are companies that are investors with very optimistic views of the future, and low are those with low expectations for the future. So that's all it means. It's a reflection, a metric of the current state of the market and its perception of that company. We're going to go to Yahoo Finance as the data source. And there are many sources to find market data and price earnings ratios, but Yahoo is easy to use, and I like it because it's pretty comprehensive. Where you'd find it is as follows. So this is the main screen, the summary screen for Logitech on Yahoo Finance. And it shows a few things. First, you'll notice the price right now, and we're active trading right now. The picture here can be scaled to different time frames. I put it on 5 years to show the price history since late 2013 to 2018. It shows the price earnings ratio right here, 30. It shows the earnings per share here. It shows a lot of other information that's valuable, but we're focusing obviously on those three metrics. All right, so we'll hop back to our slides and say this is the face page or the summary page for Logitech, and we are going to focus on certain numbers. The numbers that we just mentioned are price, the PE ratio, and the EPS. And those are highly related because you take the price of 38 divided by earnings per share of $1.24, the PE ratio is 30.87. There's not a lot of magic in that. That's just how it works. Now the next thing we will look at is another screen that's on Yahoo, and it's right here called Analysis, right? Analysis. and I just clipped it here just so we can focus on the key parts. It will show that we have a number of analysts. Here there are 11 that are estimating the current year. The average estimate of EPS is $1.83 with a low of 1.7 and a high of 1.91. So it's not exactly a high variation. So there's not a lot of controversy about Logitech and where it's going. And a year ago it was $1.60. So you could see that in general, analysts are believing that Logitech is going to improve in the coming year. If you look on the right side, right next to where we saw the averages, is the summary of the range of opinions from the analysts. This kind of heat map shows strong buys of the dark green, buy of the lighter green, yellow of hold. So nobody is saying that this stock will underperform, or no one is saying sell. The average is here, which is a buy recommendation. And if you take the average of the prices that are projected by the analysts, you get this number right here. Average of 52.33 with the current price, as we just saw, of about $38. So how can we use this for the project? So the current price, as we just saw, 38, EPS of $1.24, and that has a notation of TTM, which stands for trailing 12 months, and the PE ratio of 30.87. Analyst opinions are averaging about $1.83 for the EPS, and average expected stock price is 52, which implies a PE rate when you divide price by earnings of 28.53, and the average recommendation is to buy. So what do we think? Well, if we thought that the EPS is going to be $1.90, I just picked a number, I didn't do any analysis, and if we expect the PE ratio to rise to 30, the expected price would be 57. With a price of 38 today, that would sound like a buy recommendation. So that's what I want you to do for the project, just to get an indicator of what the view of the market is today of the stock that you're analyzing, and do a little crystal ball on what you think EPS is and what PE will be. You can use the same PE if you'd like, but if you want to get a little more ambitious and estimate the PE also, you can do that too, and you get a price. Again, the main purpose of our project is the financial analysis, using financial statements and the ratios and trends and common sizing to be able to give assessments for how the company is doing based on historical performance. This is just kind of the whipped cream and cherry on the top of your sundae, right? Just to show that the extension of this ultimately will be to get to an evaluation of the stock price and a recommendation to buy, sell, or hold. So that's it for where we're going. And I will look forward to seeing your presentations. Bye-bye.